Hi everybody and welcome to today's webinar, which is our second of 5 webinars leading up to Christmas. My name is Sinead and I'm Client Support at Turner Accountants and I will be your moderator today. Okay, so before we get started, sorry, just getting the slide up for you. Okay, so before we get started, for those of you who are unfamiliar with the webinar environment, these are the Zoom settings. So let's take a closer look. So to test your speakers, select audio settings. If you've got any questions throughout the webinar, you can submit them via the Q&A button and we'll answer your questions at the end. If you need to leave the webinar at any time, just click on the red Leave Meeting button. Okay, so now I'd like to introduce you to today's presenter, Director at Turner Accountants, Mr. Mike Turner.
Hello everybody and welcome, as Sinead said, to the second of our webinars in our autumn series. We've another one in a couple of weeks on the 12th of November, which is the third out of 5, which is 7 ways to grow your business. So if you've got your sandwiches, your soup and your yogurt or your bun and your cup of tea or maybe a sneaky G&T, then we'll get started. So, thought for the day. Before I start, I thought I'd share a thought for the session. The budget is not just a collection of numbers, but an expression of our values and aspirations. Hopefully, you've all updated your budgets and forecasts to reflect the challenges of the COVID-19 situation. These numbers express your aspirations for the business over the next 12 months. Now it's time to make sure you can understand, monitor and measure what you've set in those budgets and forecasts. This webinar is about demystifying the most common reports you'll be seeing on a weekly, monthly, quarterly and annual basis so that you're in control of your business performance. Over the next 45 minutes, we'll cover the importance of knowing your numbers, an overview of the different reports you should be producing, the difference between profits and cash, the key drivers of business value, how to protect your assets and how to adopt best practice. Then we'll outline some potential next steps for you to make sure you're truly understanding your numbers. Make sure you take plenty of notes today. Some of what we talk about might sound like a foreign language to you. It does to me sometimes as well. What I can call accountees. So send through your questions at any time during the webinar for us to answer near the end. Why you need to know your numbers. Knowing your numbers is vital as it allows you to interpret your reports and know if you're on track to achieve the goals set in your business plan. Here are my top 6 reasons why you need to know your numbers. They tell the story of your business, allowing you to interpret the results of your business activity. 2, this helps you identify the symptoms the root causes. For example, a decline in gross profit. A decline in gross profit is a symptom of many root causes such as ineffective pricing, rework, poor purchasing, or wastage. Knowing your numbers will enable you to spot an early sign of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. Areas of strength and weakness will be highlighted. For example, your balance sheet indicates whether your business value is going up and down. Understanding your numbers also means you have a reliable financial information to base your decisions on. And finally, knowledge is power. The more you know about your business, the better your business will be. I think maybe had a bit of a technical issue where the slides weren't showing, but hopefully we sorted that out. Okay, next slide. Overview of key reports. So knowing your numbers means that you have to be aware of some of the key reports that we produce for you or you produce yourself. We'll be reviewing each of these key reports to help you understand what you can learn from them. We'll look through an example to show key learnings and things to look out for in your reports. We'll use the same fictitious company, Foods Co, for the examples. So trading account. Your trading account tracks your sales, your variable costs and gross profit to calculate the return you're achieving before deducting your fixed overhead costs. So obviously this is a really important report because the more you're increasing your gross profit, the more money you're making. You can track your results across different divisions or product lines by using multiple trading accounts. For example, if you have regional locations, have a trading account for each location, which allows you to track how it is performing. And you can do this in the Xero software that we're gold partners for. Small adjustments to the items in your trading account can have a huge impact on your overall results, which I'll demonstrate now. So this is an example of a food manufacturing company's trading account. As you can see, they had just over £1 million of sales, and the cost of sales was 318,000, giving them a gross surplus from trading of just under 700,000. Their direct costs were just over 450k, so their gross surplus was 248,000, giving a gross profit percentage of 24%. Let's say this company undertakes coaching with their accountant and implements strategies to increase their customer retention rate, resulting in a 10% increase in sales. They also work with us to review their stock process and reduce their cost of sales by 5%. They renegotiate their contract with their delivery provider, providing a 5% saving in their direct costs. As a result of these changes, their gross surplus has increased by £140,000 and their gross profit percentage has increased from 24 to 35%. Understanding your trading account allows you to identify areas where small improvements can have a big impact on the profitability of your business. So your profit and loss account, also known as the income statement, shows all your earnings and costs over the year, tracks the overall performance of the business. It matches income and expenses for the period with adjustments made for timing differences. For example, sales that have been made but money hasn't been received for yet. It's important to remember that profit is not the same as cash. The profit shown in your profit and loss statement includes non-cash expenses such as depreciation. You must ensure you have sufficient profit to cover costs such as loan principal repayments, asset purchases, and drawings. Your profit and loss statement provides a framework to benchmark your results by using percentages or comparison between years to compare your business performance to similar businesses. Business is generally valued as a multiplier of earnings, so your profit and loss statement is a fundamental driver of the value of your business. The higher your earnings, the higher your business should be worth. This is an example of a profit and loss statement using the same fictitious food manufacturing company. We've taken the gross surplus from the trading account at the top, 248,000, and listed all the expenses, followed by the owner's remuneration to calculate the net surplus or loss. As you can see, the company is trading at a loss of over £113,000. Let's say the company undertakes a review of all their expenses with their accountant and identifies potential savings to be made to the insurances and to the rent. They contact an insurance broker and their landlord and negotiate a 5% reduction for both expenses. They save 597 quid in insurance expenses and just under 3,000 in rent expenses. However, you'll notice that the accountancy fees have gone up. Remember, in the previous example, the company engaged the accountant for coaching and other services. Despite the increase in the accountancy fees, the overall surplus has increased by £138,000 to £24,000 due to the savings made. Okay, so let's move on to the balance sheet. Your balance sheet, also known as the statement of financial position, provides a snapshot of your business financial position at a specific point in time. So the balance sheet changes day to day, hour to hour, depending on when you're looking at it. So it measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent. If your liabilities are greater than your asset, then the business is solvent and your is insolvent, and urgent action is needed to fix this. You can compare different periods to determine whether the business's net worth is increasing or decreasing between years and months, and can track the strength of the business. The stronger your balance sheet, the easier it will be for you to survive a downturn like we're in. It also provides a basis to calculate key ratios such as debtor days and stock days. As you can see, the company is currently insolvent as it has more liabilities than assets. So that's the negative 305,000 at the bottom of the page. Its working capital is also negative. At current assets are less than current liability. Current assets are £138,000 and the current liabilities are £162,000. This means the company cannot pay its short-term debts from limited cash debtors and stock it has on hand. The banks will often look at this current liability stroke assets figure as they take it as a very good indicator of whether the company is solvent or not. So urgent action is required to remedy. In this case, the business needs an injection of funds of at least £305,000 down at the bottom, which may be in the form of share capital or director's loan. Assuming the company can resolve the urgent solvency issues, there are other areas of improvement too. Over the long term, the company could implement strategies to reduce their debtor days and stock days to increase their cash flow. To calculate your debtor days, divide the debtors by the sales, then multiply by 365. This tells you how long it takes customers to pay you. Currently, this company has debtor days of 26 days. That means on average, it takes customers 26 days to pay their bills. If they updated the terms of trade or increased their collection processes and requested payment within 7 days and managed to reduce this by 5 days to 21 days, they'd have an additional £13,000 available. To calculate stock days, divide stock by the cost of sales, then multiply by 365. This tells you how long the business holds its stock for before selling it. In other words, it shows how long your cash is tied up in stock. This company currently holds stock for 74 days. Again, if they reviewed and updated their stock processes, i.e. bought stock shorter period of time before they needed it, or got the stock flowing through quickly and reduce the amount of stock that they have on hand, then they might be able to improve the stock days by 9. This results in a cash flow boost of £7,860. So whilst this cash flow gain of nearly £22,000 doesn't fix the solvency issue, it demonstrates how much cash could be saved with some help from their accountant. So statement of changes in capital and reserves. So the capital and reserve statement is the bottom half of the balance sheet, and it shows what happens to the profits. They could be paid out as dividends or kept in the business as retained earnings. It represents the net worth or value of the company and is a key indicator of the company's financial health. It shows whether a company is solvent or not. Remember, if the company has more liabilities than assets, it's insolvent and funds will be need to be paid into the company. So in this situation, the company has accumulated losses for at least the last 3 years. This means the company has no retained earnings and is currently insolvent. As you can see that at the bottom, in 2019, it was insolvent by 191,000, and in 2020, it was insolvent by 305,000. There's no money to pay out dividends and no money to reinvest into the company to purchase new assets. The directors must take action now to increase the profitability of the company. The director's loan account. So the director's loan account is a running record of funds introduced to the business by the directors or taken out of the business as drawings. So if you're a client of ours and you have a limited company, you will always hear me talking about the director's loan account. So it can help you monitor your personal expenditure in the business, and for the business with more than one director, it maintains a balance of the amount each director has introduced or withdrawn from the business. It shows how much the business owes to each director. If the account is overdrawn, i.e. director owes money back to the company, then that could cause a tax problem as well. So to resolve that and to put the account back into a positive balance, the director can repay the loan or the company increase its profit to pay a director a salary or a dividend. If the director's current account is overdrawn, it's important to get advice from us as soon as possible to discuss the best options for you and your business. So let's have a look at an example of a director's loan account. So the director's loan account here shows at the start of the period, the company owed its sole director, Mr. Doe, over £29,000. He's introduced another £2,000 during the period, but it's taken out nearly over £9,000. So his director's loan account during the period has gone from £29,000, the company owing to him, to the company only owing him £21,000. The amount owed by the company to Mr. Doe can be repaid if the company is solvent and has the money. Because our company is insolvent, Mr. Doe will need to introduce more funds into the company, so it's not trading whilst insolvent. To ensure the company will be able to repay the funds introduced, a profit improvement strategy should be implemented so the company becomes profitable. For example, we demonstrated in the trading account and profit and loss statement examples how small changes to processes could result in an improvement of £138,000. It's not sustainable for the directors to keep introducing money into the business if it's not profitable. Fixed asset register. Not all companies have this fixed asset register. Most of smaller companies won't have a fixed asset register. Larger companies will. If you're a smaller company, then we will usually maintain this for you when we're producing the accounts. So what is a fixed asset register? Basically, it's a register of all the assets that the company will has, like vans, cars, software, computers, plant, and it will have a record of its opening value, your purchases and your disposals, and also how you depreciate it. I won't go into this in too much detail, but basically it shows you how much that asset is worth after being depreciated at the end of the accounting period. Okay, something a little bit more sort of relevant is the difference between profit and cash. I'm sure you've all heard the sayings, turnover is vanity, profit is for sanity. Well, to that you can add cash flow is reality. So it's common for business owners to get frustrated that the bank account doesn't seem to reflect their profits. Time and time again, I'm asked the same question. It's essential that you understand the difference between profit and cash, and why high profit doesn't necessarily result in more cash in your bank. A profitable business can go out of business because it's starved at cash. It seems strange, but it's true. A business running at a loss can survive because it has access to funders from investors or financiers, or it does things like not pay creditors. In other words, cash flow is every business's reality. So, to demonstrate the difference between profit and cash, consider these items. VAT. This affects your cash balance, but not your profit. Loan repayments. This affects your cash balance, but not your profit. Interest on loans. Affects both your profit and your cash balance. Asset purchases. Only affects your cash balance. Asset sales only affects your cash balance. Depreciation only affects your profit. As you can see, even if your business has achieved a healthy profit, there may not be any cash in the bank after paying tax, making loan repayments, and buying new assets. Okay, so let's look at the Business 101 cycle. The Business 101 cycle is another useful way to demonstrate the difference between profit and cash. First, the owners need to invest some money in the business to get it going. This money can then be used to purchase the assets needed to run the business. The business may need additional funding to buy all the assets they need, so they may take a loan to finance the purchases. These assets are then used to generate a profit. You can increase your profit by growing your sales or your margin on your sales, but overhead expenses can drain your profit and result in a loss if they're not managed. The profit then gets turned into cash. Drains on your cash include slow collection of debtors, high stock days, loan repayments, tax repayments, payments to suppliers. A business can achieve cash gains by collecting their debtors faster, decreasing their stock days, negotiating longer payment terms with suppliers, and reducing tax, which obviously we can help with. The owners then take cash out of the business as drawings or personal loan repayments. The remaining cash can then be reinvested into the business to purchase more assets and to generate more income. The aim is to go through the cycle as quickly as possible to increase your return on investment. Okay, after cash flow, business value is the next important measure of the business success. Time again, people ask me, how much is this business worth? How much can I sell my business for? Because, you know, for a lot of people, the value of their business is part of their pension plan. So part of knowing your numbers is understanding and measuring the drivers of your business value. These drivers might be recurring monthly revenue, revenue growth, revenue per client, sales or profit. These will be different for every business, but we can work with you to identify the drivers of your business value. So how do we go about that? To enhance the value of business, you must first develop and implement a clear plan and document your organization structure and roles within your business. Establishing cloud-based real-time reporting allows you to make better decisions and review the documentation, your systems and processes, ensure your business is running as efficiently as possible. Reducing the reliance on the owners of the business help enhance the value, as it will be easier for new owners to take it over when the business is sold. So if you're not as important to your business, then that will make your business more saleable because it doesn't depend on you. So again, we're always advising businesses on systems, processes, how they can then reduce the reliance on the business owner. It also means that the business owner doesn't have to be at the business to run it. He can be sat on the beach sunning himself and the business is still earning him money. And finally, identifying and managing risks means these can be mitigated before they become an issue. So, protecting your assets. As we've seen throughout the webinar, the profitability, cash flow, and value of your business all affect you personally. If your business isn't profitable and doesn't have much cash available, you won't be able to pay yourself to fund your desired lifestyle, which again, it's all about. There are a few other things you can do to help protect your assets, which I'll quickly run through now. Set up your business as a company to limit your personal liability. So if anything happens to the business, then creditors can only get at the value of the money in the business. There are things where this isn't quite true, where if you buy an asset on HP or if you take a bank loan out, then they may ask you to personally guarantee that loan, thereby sort of them getting around the period of limited liability. Consider who should be directors of your company and which assets are held personally by directors. Ensure that you have security over the money you lend to others. Consider alternative ownership structures for high value assets. For example, if your business owns the commercial premises you use, consider moving that ownership of the premises to another limited company to protect it from the trade. Review your terms of trade and credit policies to ensure you only provide credit to customers who can and are likely to pay. Review your insurances and make sure you have sufficient protection and cover. For example, do you have business interruption insurance, indemnity insurance, and enough cover to ensure the impact of your business on any adverse event is minimal as possible. Ensure you undertake financial planning to manage your personal wealth outside of the business. And finally, plan for the future. Do you have an up-to-date will? Do you have powers of attorney? A clear plan for transferring your assets to the next generation? This isn't an exhaustive list. They're just some ways you can protect both your business assets and personal assets. We can help you identify specific ways you can protect your assets. So, how does everything I've talked about come together today as best practice? Every business should use the 3 following essential tools. You not only should, you must have an annual business plan, or in these times, a business recovery plan. It doesn't have to be complicated. It can be 1 page, but at least it gives you a focus point in the direction of your business. You need an annual forecast. Again, you need to set targets. You need to look at your expenses and set budgets. So you've got a plan, so you know how much money you're going to make or hope to make. And you should have ongoing reporting and accountability. So once you've done your business plan, once you've done your forecasts, then you're going to track those forecasts and against actual figures. So you've got to have some sort of accounting software. Like I say, we use Xero, which is really good. And so you can ensure the numbers you want to achieve in your plan and your forecast are being measured. The accountability process is some form of coaching. So yeah, so once you set these numbers and once you're tracking these numbers, you need to sit down with somebody and get them to go through with them so you're accountable to them, so you're not just going to ignore them. Using an independent coach like ourselves to hold you accountable works time and time again. I myself have a coach and I find it invaluable. Knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve your goals for your business. So what are your next steps? Get started now. Write down write down 3 actions that you're going to have from today. Write down what those actions are and what you're going to do with them. If you don't currently have a business plan or business recovery plan, my aim to help you to what you've learned today and implement some positive changes in your business. So it's time for you to decide what you're going to do. Take a few minutes after the webinar to write down 3 actions or projects that will add the value to your business. What problems are you experiencing in your business? Identify these problems and use them as an opportunity to create a project to fix them. Look at the problems and rank them. Rank them into the problem that's giving the most grief, and then deal with that first. Doing nothing right now should not be an option. So now you know about what you should be doing as best practice in your business. Here's how we can help. If you don't currently have a business plan or business recovery plan, we can help you develop one. We can also create an updated cash flow forecast which reflects the ongoing impact of COVID-19. For those who need to be held accountable to complete your actions, we have a range of coaching options depending on the frequency which suits you. We can create your management reports each month so you know your numbers, catching up with you to review them so we can discuss potential areas for improvement. And finally, we offer complimentary 1-hour meeting for both clients and people who weren't clients. We know it may be difficult to commit to spending money right now. All these services include assessment as how you can improve your profitability and cash flow. So there will be a great return on investment from this process over time. For the short term, we have a different payment options available, so please don't let cost be a barrier. Get in touch and we can work together to come to an arrangement we can manage, you can manage. Okay, let's see if we have any questions. Okay, thanks very much. Yeah, so I've got a question here. It says, I don't really understand profit and loss accounts and balance sheets fully. Let's put my video on for you. Yeah, so what can I do to keep track of my figures? If you don't understand figures properly, then what you need to do is identify 7 key figures each month that are critical to the running of your business. So this may be the gross profit percentage, or debtor days that we've talked about, or things like number of return goods, or number of complaints, or days sick with your staff. But you should have a range of maybe 7 of these key performance indicators by which you can manage your business if you don't want to produce full accounts. and your accounting software can help you with this. And from that, you can produce a scorecard, a monthly scorecard of which you can measure how you're improving with these. Okay, what's the next question? Yeah, I've got another question here. It says, I don't really get the director's loan account and how that works with dividends. So, as you saw before, I tell people the way to think of the director's loan account is to think it as a bank account. So if you're taking money out of the company, then that's coming out of your director's loan bank account and reducing it from the drawings that you make each month. How do you top it up? How do you pay money into that bank account? Well, there's two ways to pay money into that director's loan bank account. You can do that with dividends voted from the profits, or you can do it by putting money in from your own personal resources into the company. Okay, and I think we've just got time for one more question yet. So here it says, I'm always hearing you talk about profit and break even and cash break even. What's the difference? Well, again, hopefully in the webinar, you'll have seen that. So we start with the profit for the month, and you say, how much profit have I got to make how much sales have I got to make before we get to a profit? And that will come up with a sales figure. But beyond that, there are other things that we saw that aren't in the profit and loss account that you'll need to cover to make a cash break even. So that's things like corporation tax payments, the capital loan repayments, purchase of assets. So you've got to add those other things in before you get your cash break even turnover, which will be higher than your profit break even figure. And yeah, and also in that, it will obviously include the dividends that you take out of the company. Okay, got no more questions coming in. Okay, but thank you very much then for attending this webinar. I hope you've enjoyed it. If you have any questions or further questions, then please come back to us. Hopefully we'll see you on November the 21st, which is 7 ways to grow your business, which is a really interesting topic. And thank you very much and enjoy the rest of your day. Okay, thank you. Bye.